Welcome back, everybody. We're on kind of installment 6 on chapter 6. And this is going to wind us up on chapter 6, where we're talking about price levels and inflation. One thing we're going to talk about in this last segment is actually what are the consequences of inflation? If you think about kind of the supply demand curve, and you think about every market transaction, there's a buyer and a seller. Somebody's generating product, they're selling it, somebody's buying product, that individual buying is seeking a product and they have willingness to pay. Sellers generating a product or accumulating a product for sale and are willing to sell to a certain price. And as long as those buyers and sellers meet and there's a market transaction, it's actually clearing the market on any given commodity in any given time, because you've got buyers and sellers coming together and completing transaction. And not only is it buyers and sellers, but you're thinking about expenditures and incomes. The buyers are having to pay for something. These sellers are selling something and they're getting revenue for it. And I guess if you look at inflation and the consequences of inflation, as inflation, if it goes up and it goes up in nominal terms and it increases wages, then there may be little to no change in real prices. So I see, you can make that argument. Now, most economists might not agree with that argument, but if you make that argument, you can probably get by with making that argument. That is everything stays the same as nominal terms, and if incomes and wages and the income received from on the seller side and the expenditure side and the wages, if everything stays the same in nominal terms, then maybe there's not a huge impact on inflation. When we talk about inflation and the consequences, there's some direct cost inflation. There's, as we talked about, there's the implicit, inflation tax, or the implicit cost to people that hold money. So if you're putting money under your mattress, or you're taking it and putting it in a savings account, and let's say your savings account is getting 2% and inflation's, and as it was in 2021 and 2022, running in that 6-7%, 2021 and 22 run at that 6-7%, then that is basically looking at an inflation tax, because you're not staying ahead of inflation. So you're losing the purchasing power of your income, the purchasing power of not only your wages but your savings. And it makes for a difficult situation where you can't at least stay ahead of inflation. And what happens when people are faced with a tax? So if I think about personal income tax, I'm going to take every advantage possible when I'm filing my taxes in April every year, because I don't want to pay a tax if I don't have to. Same thing with state tax. Think of all the people who will move to a state like Texas, Tennessee, Florida, state of Washington. I don't think Nevada has a state income tax. So individuals will move to those states for employment because they don't want to have to pay the state income tax like you're faced with in California, New York, or some of the states that have larger state income taxes. So people will go to great lengths to avoid paying taxes. It's the same with property taxes. Different counties in a given state have different property taxes or different property tax rates, and individuals will actually move into those counties with lower property tax rates. And they talk about the direct cost of inflation, and one of them they talk about is the shoe leather cost. And I can agree with this being the shoe leather cost if it were well, even 5 years ago, because you've got individuals trying to avoid inflation. They're trying, investing in their savings, taking out a savings account, putting it in gold. They're holding cash, putting it in foreign currencies. So it takes away the velocity. If you think back, the money velocity equals the nominal GMP on that, GDP on that. So it's driving down the velocity piece of it, because they're trying to avoid that tax and putting it, locking it up in gold or locking it up in foreign exchange rates or foreign currencies. And they talk about the number of times they're either going individuals to avoid that inflation tax and avoid the erosion and the personal purchasing power of their funds or their disposable income. They are spending time that, either takes away from productive time or takes away from leisure time, because they are constantly trying to manage their money, trying to move it around. And at the time when you were having to go in person to brokerage houses, or at the time you're having to go in person to banks, that makes sense. But now with the internet, and you've got the online brokerage firms, you've got, at any given time, you can shuffle money around, in your banking account, from savings to money market to checking accounts. So you've got a lot of flexibility, but it is still, you have individuals that are spending time, even though they're not wearing holes in their shoes now, they are still spending some time trying to manage the purchasing power of their assets, or the purchasing power of their resources. The second thing you've got is, they call it the menu cost. And, they talk about restaurants, especially restaurants with extremely extensive menus or items on a menu. They're talking about having it, trying to adjust prices, how cumbersome it is and how costly it is, and trying to adjust those prices to try to keep up with inflation. Their vendors are maybe charging a more price or a higher price for the goods, the intermediate goods that they buy in the restaurant to prepare the dishes that they sell on their menu. So they're trying to figure out how to pass that cost on to the consumer. So, they either have to do it by reprinting menus, or essentially leaving prices as they are. And that increase in the price of the intermediate goods is actually draining their profit, or working into their profit, or cutting their profit margins. If you think about your local gas station, they can change, the price on that gasoline at the pump in a heartbeat. I mean, they can change those prices. Anything that kind of flows along those lines, that have menus that are easy to change. Some restaurants have items that they will sell that may not be on the menu. I think Starbucks, one of them. Starbucks, if you go in, they've got kind of a limited menu displayed. But at the same time, they may not have pricing on there, and a lot of restaurants anymore don't have pricing on their menus, and it's just in their kind of bank of rates. And as the waitress or the server keys in an order into the system, then it's automatically calculating those prices and assigning it to the bill that you receive at the end of the day. And you compare that, trying to think of a different. If you're a healthcare provider, so let's say you're a primary care doc, you're in practice, you've got some Medicaid patients, you've got Medicare patients, you've got a bunch of commercial patients, TRICARE patients, and that is your pool of patients that are going to help you generate revenue. If the cost of your factors of production, if your cost of everything that goes into generating those office visits are going up, how are you going to pass that on to individuals? So you can, within healthcare, there's a mechanism called a charge master that you can change on a periodic basis, and that's the bill charges that you're going to bill either private paid members, government agencies, health plans for the services that you provide. But at the end of the day, most healthcare contracts, whether it's commercial or they are negotiated usually, 1, 2, 3-year terms. The rates usually don't get kicked up until January of each year when the new contract rates go into effect. If you're talking about Medicare, Medicaid, TRICARE, government agencies, they have fee schedules that I think on the inpatient side changes on October the 1st of each year and January the 1st for like individual providers. But those fee schedules, with rare exceptions, are pretty much etched in stone until the next billing cycle or the next payment cycle comes around or the next fee schedule change cycle comes around. So if you're on the healthcare side, it makes it really extremely difficult if you're a provider to pass those kind of costs on to a payer unless you have a contract that's written as a bill charge contract. If you have a bill charge contract, every time you adjust that charge master, you're going to get new bill charges on that claim and you'll get paid a different rate. So that's on the healthcare provider side. If you flip it over to the health plan side, most of the fully insured business that you have, so premiums that you're charging individual employer groups, again, those are really negotiated on an annual basis. So you're not going to get a bump in your premium dollars until that new contract comes available or that new contract rate becomes available in January of each year or sometimes in July of each year. It depends on the fiscal year that the employer group works on. And the other alternative to that is if you're a fully insured employer group, so where you're paying your bills by yourself, you're not going to see that much of a bump up because the bill for the healthcare services that your member and your employer group gets, since you're at risk, fully at risk for all of those services, you're not going to see really on a per unit bump up until the new healthcare contract goes into effect with the new providers, usually at the first of the year. So it's really on the healthcare side, it's difficult to keep up with changes in pricing. It's more difficult even from the perspective of a restaurant for the healthcare community to keep up prices based on the way the contracts are written. Similar thing if you're in a union shop and you've gone through a collective bargaining agreement and you are guaranteed a bump in the wage rate, say January the 1st every year, there is usually some kind of, COLA agreement in your contract, and you're going to get incremental annual increases in the wage rate. And they may be tied like with your CPI, consumer price index. They may be tied to just flat, 2, 1, 2, 3% changes each year. But it's difficult once that contract's negotiated and once it's in place to get anything changed. So that's kind of talking about the menu cost, and it's going to impact different employer groups, different businesses in different ways. Some easier, like your gas station, to change your prices at the pump. Others, it's more difficult to change. And then you've got indirect cost, and they talk about consumption distortions. And it's a change in the consumption patterns for the goods and services that you're buying. You think about, and that's a lot of it's based on expectations. So if you're listening to TV and you're listening to the business news and they're talking about, inflation is just rampant, you may actually make a decision at that point, take money out of your savings account and try to purchase those goods now rather than waiting until later or waiting to when you were going to actually buy them. So at the end of the year, say in November, December, you're looking at buying a new air conditioner, you're looking at buying a new kitchen appliance, looking to buy a new car, and you know that the prices are automatically going to bump up sometime within the next year, you may decide and change your consumption package or your consumption preference at that point to buy them sooner rather than later. So basically, you're abandoning your savings goal to buy today, and savings tend to smooth out consumption over time. And now with this consumption distortion, you're actually buying a lot at a unexpected time because you're trying to beat the impact of inflation. You've got inflation variability and investment distortions, and that's where you're talking about companies. So when the investment distortions, you're talking about capital investments, you're talking about new buildings, new machinery, new pieces of equipment. You're sitting there and you've got a very lucrative job going now with you've got your own taco truck, like a food truck that circulates around. It's doing really well. You've just bought your second one and put it into production, and it's doing really well in another part of the city. And 2 months ago, you saw this building pop up. It's available. It's been a restaurant. There's not much needed to go and open a new permanent fixture. So you've always wanted a Mexican restaurant, and now you're sitting there. Do you go into business now? Are you concerned with inflation? What's it going to do to erode the purchasing power of your clientele? So there's a lot going on in your mind, and you're trying to figure out with these investment distortions, how do you invest your money? Do you do it now? Do you wait 6 months and to see if the variability and the inflation starts to smooth itself out? Or it makes difficult decisions that much more difficult, because you're talking about the livelihood of your business. You're talking about the income stream that's going to go to you and your family. You're looking at profit margins. You're looking at the individuals that you're going to bring on to help you. What's it going to do if you have to lay them off, if the economy, while it's, kind of expanding now, if it turns into a recession. So a lot of these issues are playing on your mind. And that one of the biggest issues with this investment decision is, what's it going to do to that production possibilities curve we've been talking about? So, remember, it's concave to the origin. And if you're fully employed with your resources, if you're efficient, you're sitting on that production possibilities curve. If you're inside it, you're not efficient and you're not fully employing your resources, you're not reaching your full potential. But if you delay your investment decisions and hold on to your money, you're not going to be able to help the economy itself push that production possibilities curve outward away from the origin, and actually help improve the growth and continue to drive the growth in the economy. So that's where they're talking about the investment decisions. And then you've got tax distortions, individual tax brackets. And we talked in one of the earlier chapters, talking about taxes. If it's a C corp or an S corp, you're getting taxed twice. The corporation's getting taxed, and then they're turning around and taxing you on the personal tax. If you've got a partnership, sole provider, there's liability issues involved there. You go to LLC where you don't have liability issues and you're only taxed once as personal tax. So there's a lot of tax decisions to make, and individual tax brackets. So on your federal, personal, and to some extent your state personal taxes, inflation, they're adjusting those tax brackets, or adjusting the bottoms of those tax brackets to raise them, to try to help keep lockstep with inflation. So there's some, leeway with the tax brackets when you're talking about inflation, but they talk about your capital gains tax. Capital gains tax doesn't change with inflation. If you're going to sell a piece of property, and you could have gotten $100,000 for it last year, and now you get $125,000 for it. You think, man, that is great. I bought it for 75. I could have gotten 25,000 last year. I'm going to get an additional 25 this year, so I've got $50,000 in theoretical capital gains. But a lot of that could just be price inflation. And if it's price inflation, then you're being taxed on that price inflation, because the capital gains tax is not moving upward as inflation. It's not making that adjustment for inflation. You've also got money illusion and price confusion. And if they're changing in the overall price levels, what do you do if you're well, let's just say you're a business. If you're a business and all of a sudden you see the price going up on the product you're selling, do you make the assumption, or do you say, oh my God, the demand for my price is going, is really increasing because the price is going up? Is it demand is actually, is it actually shifting outward and actually making an adjustment on the price? Or is it just nothing more than just price, price level inflation that's causing the price of your commodity or the price of your product to go up? And so at that point, you're trying, as a business owner, trying to determine, what do you do? Do you expand productivity to try to get more items that you can sell at a higher price? Is it nothing more than inflation, and is it pressure on price from inflation? And do you step back and wait 6 months to see if the price levels out or comes downward? So again, it goes back to, as you as a business owner, how are you going to make those decisions going forward as far as what you do with the production process and how it's going to impact that production possibility curve for your particular item? And then lastly, it talks about income distribution or income redistribution. And we talked earlier about kind of the inflation tax, where it's redistributing income from households to government. That one's fairly straightforward. But one thing that some people don't think about is it redistributes income, or it redistributes money from creditors to debitors. And what that means is, if you borrow money at last year's rate of inflation, and now you're paying back at this year's rate of inflation, it's easier to pay back that loan because you've gotten more nominal dollars to use to pay back that loan. So sometimes individuals don't think their way through that one, but it is. And even though creditors try to build some of that into the agreement, sometimes they don't build enough wiggle room into that agreement. So it's actually redistributing the value or the financial value of that contract from the creditors to debitors. And then the last thing they talk about in this chapter is what to do about deflation. And it's that, downward pressure on price. It keeps, how do policymakers, keep the economy running at full potential? And so deflation may be, and to some extent, even more problematic than inflation is. So, and as we talked earlier, I guess, in maybe the first segment in this chapter, stagflation is one of the worst issues that policymakers face. And, how do they handle that when you've got inflation, driving, price levels up, and you've got the economy, it's stagnant, it's slowing down, it's hadn't really come to a complete halt, but you don't want it to get to that point. So that's it. If you're a policymaker, you're always faced with those kind of issues. That kind of wraps it together. We talked about consumer price index. We've talked about price levels and inflations. We've talked about volume of the volume of money, the velocity of money, how that relates and how it's compared to like nominal GDP. And we worked through some of the formulas together. And at the end of the day, maybe rather than multiplying on on the velocity of money and then the capacity or the quantity of money. Maybe you look at the percent change. It's just an easier formula to manipulate and to work with. So we've also looked at the consequences of inflation, and so we've kind of gone through a couple of the issues that macroeconomics focuses on. We've gone through growth, measuring GDP. We've gone through, price levels and, inflation, deflation, stagnation, stagflation. So we've kind of gone through kind of two of those. And then in chapter 7, we're going to get into unemployment and talking about unemployment, employment rates, what causes unemployment. Is it frictional? Is it structural? Is it cyclical? What we can do to kind of smooth that out. But we're slowly moving our toolbox along kind of along the continuum of pieces of information and tools we're going to bring into that toolbox, because as you continue to work through the chapters in this text, it's going to continue to draw on those tools and those components in the toolbox that you already have. And it's going to continue to add to them. And if you understand the components of that toolbox up through chapter 7, actually up through chapter 8, you should be able to position yourself pretty well to make it through and understand the rest of the text. So hopefully things are starting to come together for you. I'm going to finish up chapter 6 now, and next time I talk to you, we will jump in and take off on chapter 7. Talk to you soon.